All good? The American accent recording in progress button.
Oh, we are recording this.
All good, all good. All right, we'll make a start then. Welcome everybody. So obviously today I wanted to talk on the spotlight on ESG and ethical investing. We've got Mint and Pathfinder here to take us through that. I'll introduce them to you shortly. David Kanziora, Chair of the Society. We just want to take you through some of these sessions so everyone gets a bit more understanding, particularly around sustainable, responsible investment. We've got a few more webinars like this planned, so stay tuned. In terms of agenda today and what we wanted to get through, so I just wanted to spend a quick amount of time talking about the responsible investment spectrum. There's a lot of terms, responsible / sustainable / ethical, integration or not, or impact or ethical or thematic. There's a ton of terms to throw around, so just to try and discuss roughly where they sit in the universe, and then we can let our speakers talk to where they sit within that universe. Also, CFA Institute have quite a useful ESG integration framework, which can be quite useful in terms of how to think about things. There's a little bit of market data too we wanted to talk through. Also, obviously hearing presentations from Mint and Pathfinder, and then we'll sit down and have a Q&A. So we've got a bit of a hybrid session here at the moment too, so we've got people in the room with us. Can also ask questions, but feel free obviously in the Q&A online to put your hand up and we'll try and get around to that in Q&A. In terms of who we've got talking to you today, we've got from Mint, we've got Rachel Tinkler. Rachel's has over 5 years experience in the finance industry, the majority of which is in the responsible investing space. So she joined Mint from Milford, and where she worked on the sustainable investment analyst, implementing, maintaining the responsible investment framework. She's got a double degree in law and business, majoring in finance and international business from AUT. And at Mint, she facilitated the continued implementation of responsible investment practices for Mint. She's responsible also for driving engagement with companies on environmental, social, and governance issues. We're also joined by David Fife, portfolio manager at Mint. So David's got over 15 years experience in the financial industry. Joined Mint after returning from 5 years working in London. And during time in London, worked on global PE like Pantheon before joining Lloyd's as a derivatives analyst. Previously, David worked at BT Funds and NZ, and also as a quantitative and equity analyst undertaking sector research, specialising around transportation, utilities, and technology, both in the NZ and Australian markets. We're also joined on the Pathfinder side by David Lewis, the Chief Investment Officer there. David has 25 years experience in portfolio management and financial markets. He's currently the CIO at Alverium Wealth and his ethical investment subsidiary Pathfinder. Previously, he was Deputy CIO and Portfolio Manager at Milford, worked overseas for 12 years in Sydney and London, research and investment roles for BT and Merrill Lynch. He's also worked at a European climate NGO and consulted on responsible investment approaches. He's chaired the governance committee for Aotearoa New Zealand Stewardship Code. He's a charter holder, and his qualifications include BCom Economics and MCom Finance from Sydney, and also a Master's in Sustainability and Leadership from Cambridge. So we've got a pretty good lineup to talk to us today. Wanted to actually lay the groundwork of what we're actually talking about here. And as I mentioned, there's sort of that spectrum of responsible investment. So this is sort of how the UNPRI look at things. So on your far left, you've got that traditional investing, which is probably how things were done, obviously traditionally, but more legacy way of looking at it. And then as you sort of go across the spectrum, people might have positive or negative exclusionary screens in terms of what they want to decide in or out of their portfolio. You'll see quite a few people too now talking about ESG integration, and that's sort of further along the spectrum in terms of there's quite a few funds you'll find that is embedded in the process, and that's how they think about it. And as you sort of get further along, you might have targeted like thematic funds, you might have water funds or solar energy sort of funds. There's lots of generally climate, but you can have themes around various aspects. Impact as well, so that might be a lot more in the, don't want to quite say venture capital side, but it's more funding debt and equity to social enterprises. And then right out the other side is where you're not really caring about returns at all, and you're just mainly philanthropic, just focusing on changing outcomes. Now, so hopefully this shows up. So I guess why have a double donut when you can have a triple donut, just to make it more exciting. But CFA Institute have got their ESG integration framework. So this has kind of got three rings to their donuts. You've got an investment research sort of sitting in the middle. So it's mainly identifying material ESG factors at issuer and sort of individual security level. And you're looking for things like downside risk or maybe topics for engagement and talking with individual issuers. And sort of in the middle ring, you're looking more at sector valuation. So you might be integrating material ESG factors into your financial analysis and valuations. So you might be doing this through like your credit assessments. You might be forecasting financials, ratios, relative ranks, and all that sort of stuff. I guess that also includes sensitivity and scenario analysis, which is obviously quite useful. And then on the outer ring, you've got more the portfolio management decisions. So you'll gather up all the ESG analysis and you'll figure out sort of from a risk management perspective and portfolio construction perspective, how you're going to address those issues that you found on the inner sides. And you'll address that through things like sector weightings when you're coming up with your asset allocation. It's just a very brief overview. I sort of didn't want to steal thunder from our participants today. They'll kind of take you through how it works within their respective shops. But I thought, first of all, we could hand over to Mint.
Excellent. Just get the screen up and running here. Hi everybody, David Fife here, one of the few Davids today, but I'm the portfolio manager at Mint Asset Management, and I run a couple of different strategies, but also the key one in this space is our New Zealand socially responsible fund. And with me we've got Rachel, and we're going to walk through, I guess, how we integrate ESG within our process and within our investment team. There we go. Sorry, clicker working. So who are we? I guess I'll just do a quick intro on Mint. We are an independent boutique investment firm, been around for almost a couple of decades now. And in terms of the money we manage and who we manage for, includes a variety of clients from iwis to small individuals through to companies such as, we manage money for the New Zealand Super Fund. And within that, we run a different range of products from diversified funds through to trans-Tasman and single sector. And we tend to have an emphasis on data-driven and sort of a lot of quant work we do within our process on top of more of a fundamental research analysis. And as a business, our philosophy in terms of style, we're very much a sort of growth at a reasonable price is more traditional wording, but we are more of a growth-biased investor. And within that, we also are very much a bottom-up stock picker. So less about thematics, less about macro trends, and more about just digging into stocks themselves and working out which ones we think will add the biggest returns to our funds. And from an ESG perspective, in terms of the third sector here, we're very much a fully integrated. So I know David touched on earlier about the different processes, but we, in terms of Mint, we have it fully integrated into our investment process, and we'll touch in a bit more detail how we do that shortly. And as touched on before, an active manager. So just as a quick overview here, a little bit of a complex looking chart, but we thought we'd touch on, as an investment team when we're looking at stocks, how we break it down. Maybe starting from the right is the traditional valuation component, and that's your DCF, your different valuation tools you can run, whether it's a dividend discount model. And so we use a fair few different metrics, and that sits within our wider course, what we call our conviction score. But the other three components we include are, of course, quantitative. We run some quite heavily quantitative models, screening different factors over history and time, and looking at what works for companies. The other one we do is a few qualitative factors. That's trying to capture things outside of traditional financial metrics, whether it's around capital allocation, management teams, etc. But I guess the fourth pillar and the one we're here to talk to today is really around ESG component. And for us, that's a sort of equal weighted amongst our the four different factors here, but we use that to build scores when we rate companies, and that's how we select them and then put them into a model portfolio. So ESG is very much integrated into the wider process. And just within the ESG itself, I might get Rachel to touch on what factors we look at from a broad top-down level when we're looking at ESG.
Yeah, sure. Thanks, Dave. So I guess there's sort of three key pillars to our responsible investment approach. So this scoring system is one of those. Our what we would call traditional sort of more ESG integration, engagements or stewardship, and then exclusions as well. So ESG integration is sort of the key, the sort of primary pillar that we start off with. And so what this is essentially a risk-based approach. So what we're trying to do is understand the non-financial risks that are facing our companies or potential investee companies, and how those companies are managing them. So these are some examples of the kind of things that we'll look at. Obviously, we'll look at factors that are more relevant to one company versus another and score on that basis. So for Spark, we would be looking at privacy and data management, whereas for Fletcher's, we'd be looking at sort of health and safety practices. So then we're looking at the risk intensity and exposure, then we're understanding how the company is managing that risk, and that feeds through into a score, as Dave said, and then so all else equal in terms of scores from one company to the next, then the portfolio process would mean that a company with a higher ESG score should have a highest sitting in the portfolio.
And I guess from a systematic perspective, we use like FactSet's the software we use, but in terms of when we score these companies, we actually have a dedicated form and process. So each analyst or portfolio manager like myself, when we're looking at different companies, whether it's updating as companies evolve and produce more information, whether it's adding a new company to our wider universe, we actually have a structured form where we answer specific questions under the E category, S category, and G. And so that formalizes the process within our system. That makes it easily comparable between different companies and different sectors as well. So we do have a sort of repeatable process, which is, I guess, a key thing within a wider investment universe.
Yeah, and also, as Dave said, it also is done by the analysts and the portfolio managers. It's not something that I do and sit separately. It's very much a part of the full investment process. So then I guess the second pillar of our approach is engagement or stewardship, and one source of our engagements will be the lower scoring companies within our portfolios. And so that's what we are doing here. Oh, sorry. This sort of shows that we've got lower scoring companies, mid scoring, and then higher scoring. So this will help us to identify companies where everything else might be looking really good, but from there might be a lower E score, and so that might help us to identify how we can engage with the company, hopefully shift that score a bit higher, and then we're sort of happy to either let it enter the portfolio or to hold a bit more of it. These engagements can take sometimes 6 months, they can sometimes take 3 years, so they're very varied. Some of the examples are up on the slides now. So Spark, we've had a couple of them recently. One is around child sexual abuse materials. So obviously is one of the larger providers of our internet in the country. All the providers have to meet the government standards of filtering. But the problem with that is that government standards of filtering are very, very poor. There's an offshore charity called Internet Watch Foundation, which runs a list which identifies up to 30,000 offensive URLs, and they have team members who are constantly working through reports of offensive sites, making sure that they're filtering these out, whereas the New Zealand government's system only was blocking out about 500 sites at any one time. So that's obviously a vastly different number. And we engaged with Spark on it, and they said, yeah, but the legal point here is that we just have to follow what the government tells us, which is not incorrect. But we said to them, and this is a good example of these non-financial factors, is that there's still a reputational risk there for Spark. So yes, they won't necessarily receive this large fine because legally they're not doing anything wrong by following the government's filtering system, but they have what we call the social license to operate, to go above and beyond that. So we went back and forth, engaged with them probably for a period of about 6 months, and then we were really happy when they advised us they were moving on to this more stringent filtering system. And then actually since then, they have continued to engage with the government as well. And the government has now upgraded New Zealand's government level filter to be screening out more as well. So that was a really, positive outcome of an engagement with them.
Yeah, and I guess, on the topic of Spark, which has been in the media a fair bit recently around the board and governance, it is a name that's always more recently scored a little poorly in this area. With, that prior chart you saw, we had the red, amber and green. It had been towards the more red end of our governance score. And I guess when we slice it up, that helps us to promote these engagements. And recently, we have engaged with Spark at a board level. We've sort of talked to them about their capital management, so sometimes towards the financial side, but also board succession, the way they've sort of handled their dividend and sustainability of that dividend payout. And it's been a major issue, and you've probably seen, if you follow the share price of Spark, sort of tumble over the last year or so. And so this is one of these key areas where, as an investor and as a company, we have the ability to engage and influence. And it's good to see already we are starting to see changes within a company like Spark. On another level, one of the names that tend to score pretty well generally on ESG is actually the gentailers in New Zealand. So that's all the largely renewable energy companies. And recently this year, you would have seen some changes by the government around the fast track bill and different approaches that the government was looking to introduce. Now, for us, this is somewhat helpful for these companies wanting to build large amounts of renewable generation. But of course, it does bring a different lens, and we call it sort of almost the risk to people rather than risk to business, which is, if you're changing these large procedures and policies, what does it mean for large stakeholders, whether it's iwi land down south or whether it's a large farming area where you might see wind farms or solar farms going in? What does this fast track policy mean? So it's really interesting to have conversations directly with the companies like Meridian and Contact around how they look to deal with stakeholders in this new structure. And it's really good to say that the feedback we got from all of the ones we engaged with was around the fact that, when you're dealing with stakeholders like farmers and like iwi, these are long-term arrangements. So even if from an administrative perspective, you're getting a fast track support through process, the way they deal with stakeholders is unchanged. And so it's one of those conversations that's, one of these active ones that helped give a bit of frame and safeguards around how they'll deal with the wider universe. Because obviously, as Rachel touched on with Spark before, reputational damage can be pretty severe for companies like this if they're not following best practice.
Yeah, and that's a good example as well of we don't just sort of sit within a silo. We're also, the companies we are talking to are very much impacted by the policy settings of the government of the day. So we also engage with policymakers as well, because, obviously they're so tied together, what we do, what the companies do and what the government does. So tends to be another sort of source of our engagements is government consultations and policy submissions. This is just a quick slide to touch on sort of our ongoing maintenance to make sure that basically our process is working as it should. So, monthly we're reviewing ESG scores of the holdings to check sort of, that we're holding fewer of the lower scoring companies and more of the higher scoring companies. We're talking about what's going on in the market and the news, things like that. Quarterly, we'll be reviewing the portfolio metrics, and we've got a slide on that coming up next. And then we'll also be checking our engagements and seeing if there's any sort of, gentle bumps we need to be giving to companies to sort of give us an update on what's happening. And then also Dave mentioned the question set that we run every company through. So that is something we look at annually just to make sure those questions are still sort of fit for purpose.
Which touches on a really good point that when we're talking here, a lot of this is more around the Australasian equity market. So our focus here, being closer to home, you actually get quite good engagement. And one of the points when we look and review, to be fair, our questions is also the data and information available. So we do use some third-party providers, whether it's companies like Sustainalytic and there's other companies like MSCI, etc., that do provide this. The way we operate and the way we feel we can get best outcomes is actually doing our own scoring system. Now, there are a lot of ones you can sort of pay, subscribe and screen, and there are a lot of managers that do use those, but it's more of a sort of a gleaning across, whereas this, by getting more engagement with companies direct, it just gives you a better understanding of management and a better understanding of risks that can sit within these businesses. And I think part of the philosophy as well for us, of course, is that companies that manage risks better, both the financial and non-financial, and obviously in the ESG space, tend to have better outcomes in the long term and then tend to be sort of reasonably successful businesses. So I guess that's sort of reiterating back to some of the logic of why we do what we do.
Yeah.
And I guess this is, I love things in a visual form because it's quick and it's to the point. And so we have a lot of what we call either cheat sheets or health checks that we sit down and review, as we touched on before, some monthly, some weekly, some annual. But what this shows here, this is one of the portfolios and looking at the active positions within the funds versus how we score them. And I guess what you want to see is that your process, how you score companies and the ones you own are reflective of that. And so that's why we're monitoring it regularly. So I guess when you look at a line across there and the sort of the green area at the top is the ones that score well we should own more of, and the bottom is the ones that we score poorly that we should own less of. And so that's just on a more sort of a regular catch up. And then the little wee chart on the right is almost a quartile of the names we own, and we should own more of the ones we like, and it's just splitting it up into different ways of monitoring. So for me as a portfolio manager, when I sit there every day, I can sort of see a live picture of, you know, the alignment between things such as ESG, and we also do this with things like valuation and other quant metrics, but it's a good way to dissect the portfolio, and it creates great discussion around what positions we hold.
Oh, so this is just to quickly touch on sort of the broader I guess, responsible investment sort of ethos. We're members of UNPRI as well as RIA and the Stewardship Code, CFA Asset Manager Code, and the New Zealand Corporate Governance Forum. And also Mint as a company, we do Toitu reporting. So that's us you know, trying to reduce our carbon footprint as well. So that's sort of helping us to, you know, be a bit more authentic as well. A lot of these groups give us access to collaborative opportunities too, and increasingly investors and companies are seeing the benefits of, you know, collaborative engagement. So we can access that through these groups as well, which, yeah, we're starting to get some good momentum from across the market, and, you know, more globally as well, we're seeing it. Oh, and just briefly, these are our exclusions. So the reason we put this at the end is because you know, the more important tools for us are our integration and our engagement, but obviously exclusions are still important. And I imagine Dave Lewis talking from Pathfinder, they'll have probably a slightly longer exclusion list. But for us, we are excluding essentially activities that are illegal in New Zealand, or that where New Zealand is a signatory to an international treaty like non-nuclear. Mm-hmm.
And I guess the list is of, you know, areas we think that there's no amount of return that offsets the risk shown. And I think, and a part of the willingness and want to engage is the fact that, you know, there's a bit of academic research out there as well, but you can look around and seeing that being a part of a company's transition, or, you know, if there's a sort of set pathway, you know, you could argue it's about cost of capital as well. So certain companies, as they improve and exit sort of areas that are sort of undesirable or poor, may actually see, you know, whether it's cheaper debt or more available equity funding, can actually see that sort of cost of capital argument. So hopefully that does generate alpha over time as well. So that's sort of part of the thesis, but not so on. That is why we like to have that engagement over exclusion. That's why it's the last port of call, not the first port of call when we think about some of those different pieces. So thank you there from the Mint team. We can pass over to David to continue the conversation, if that's good.
Yeah, thank you very much, David and Rachel. Hopefully that's coming through okay.
Yep.
And kia ora koutou to the listeners. Ko David Lewis, taku ingoa, ka nui taku mihi kia koutou mō whakarongo ki tēnei hui I tēnei rā. So thank you everyone for listening to this kōrero today. So I have a bit of a presentation. Sorry if I just shrunk that again. Apologies. And this is only the second time I've given it, so it may not be completely polished, but I started with this first slide, which is to start with the least important thing, and that is me. And luckily my new colleague David Canziora has already given me a bit of an intro, so I don't need to sort of expand on that. I will ask you, for those online, if you're interested, to think about what the most important thing for our business is. And you're welcome to post anything in chat on that, and we'll try and come back to that later in the presentation. I will talk a little bit about Pathfinder. So Pathfinder is an ethical investment business. Some sort of background stuff. We're a B Corp. We're signed up to UNPRI, a member of RIA, and we like to think that our ethical process is well differentiated in the New Zealand market, and we've had some external recognition of that with winning, for example, Mindful Money's Ethical Kiwi Saver Manager of the Year, I think, for the past 5 years. This slide talks to our mission and sort of why we're here, and this really motivates everyone in the team at Pathfinder. We think about duality, so that means for us, the two pillars to what we're trying to achieve for clients is firstly to generate individual wealth, and secondly to generate collective well-being. We do that by investing ethically. So both of those sides of duality are key to how we go about designing our portfolios. Our ethical investing approach, so 3 pillars to that. The first is respecting people, human rights, and promoting healthy communities. The second is respecting our planet, in particular around biodiversity and climate action. And the third is to respect animals, and you'll see that comes through with some of our exclusions around animal testing, etc. And in order to sort of implement that ethical approach, there are 4 key steps to that, which I'll talk through over the series of the next sort of dozen slides or so. Firstly, to touch on our exclusions, so you can see all the details around how exactly we determine these. Many of them are calibrated around revenue thresholds. So revenue threshold means we look for the particular proportion of a company's total revenue that might be derived from the particular activity, and if that's over the threshold that we set for that particular activity, then we will exclude all companies in that bucket. Some of the activities we have, effectively a 0 revenue threshold. So, for example, animal testing, any company that's involved in animal testing, we will not invest in. When it comes to something like weapons, obviously defence is a very topical industry for thinking about responsible investment at the moment, and many different perspectives across the globe in terms of the ethical orientation of the defence industry. And if you ask people in Eastern Europe that are close to Russia, you'll get a pretty different answer to asking people in different parts of the world that are not close to conflict. But just to give you a sense of how revenue thresholds work for us in weapons, for companies that develop systems or indirect support for armaments industries, we have a higher revenue threshold at 50%. For some particular weapons that we think are particularly, harmful and egregious, we will have a outright exclusion, so essentially no revenue threshold, and that includes things that are effectively illegal in New Zealand, like nuclear weapons and cluster munitions. And then for other things like personal firearms, if I recall, it's a 5%, or that maybe is a 0 threshold too. But that's just an example that for some of our exclusions, we have a sort of multi-tiered approach to try and capture degrees of harm from those various activities, but consistent with what David and Rachel talked about in their very good presentation. There are some activities which for us are sort of over a red line, and if you think about a concept that's used in environmentalism quite a bit around a mitigation hierarchy, which I won't talk about in detail here, but the first step of that is to avoid significant harm. So for us, the sort of 0% revenue threshold around our exclusions is around avoiding significant harm. So you can see the rest of the list there. I won't sort of read all of those out and more details online there if you want to find it. So what are those four pillars towards discharging and implementing our ethical mandate? The first is to try and think about what we call positive investing themes. So this is trying to steer our portfolios towards investing in themes that we think have a positive influence on outcomes for people, planet, and animals. So the first is healthy living. The second is deglobalization and parts of that, and decarbonisation. The third is digitalisation. The fourth is healthy planet. And the last is social license. So I've got a few examples from across our portfolios that talk to the types of companies that reflect these themes. So starting with healthy living. So, we have investments across both our debt portfolios and our equity portfolios that are trying to support more social housing in New Zealand. Now, when you think about it, the duality that I talked about earlier, where we are trying to achieve financial returns, but we're also trying to achieve collective well-being, that does mean for some of these more sort of specific types of investments that we make, so something like community housing, it is difficult when you're trying to deliver financial performance for your clients from markets like listed shares and debt securities. It is difficult to make large allocations to something like social housing. So allocations to community finance, which is a particular sort of debt and to some degree equity provider of social housing here in Aotearoa, our allocations to them are reasonably modest at a couple of percent or in different funds. So they're not, these things are not sort of 5, 10, 15% of each fund. A couple of others there across the listed environment that you may be aware of, such as Ryman and SciDev, which is a water-based environmental company listed in Australia. Next theme, deglobalization. Won't talk through all of these examples there. Some of those companies you'll be familiar with. Digitalization. Part of the reason we like digitalization as a kind of ethical theme is that technology, although it does also bring some ethical challenges, and in particular actually at the moment in terms of the interaction of some of these companies with the defence industry, digitalisation does have the potential to bring us higher productivity growth, higher economic growth, but while using a lower intensity of demand on the natural world. So a concept that is sort of referred to as green growth, meaning that we can still deliver reasonable GDP growth and reasonable improvements in living standards for people, but without, we hope, delivering the same impacts on the natural world, including climate. The next bucket of our positive themes is healthy planet. So some of these companies involved in renewable energy, including Contact and Longroad, which is part of Infratil. We also have an investment in a private company, which I'll speak to later, in the renewable space. This slide just quickly talks to one of the other pillars of how we go about our ethical investing, and this, again, Rachel spoke to in Mint's presentation, so it's around stewardship. So that refers to how we vote in company AGMs and shareholder resolutions that might relate to environmental or social activities for different companies. We see stewardship, an important part of that is collaborating with different investors, in particular here in New Zealand and where we can overseas. But also if we're not, really seeing the outcomes that we want from our engagement activities where we're talking to companies, or from, outcomes of votes, then on occasion where we think the company's not acting in accordance with our ethical policy or what we think our clients might expect from that company, then we will divest that also. It's probably worth emphasising just in terms of engagement, which is how we talk to companies about their activities. We tend to focus that much more on New Zealand, or in fact entirely on New Zealand, given that we do think it is difficult for a small investor here to engage meaningfully with global companies. So private assets is another pillar of our ethical investing. So we do think that by investing in private companies that might not be able to raise all of the same funding without our dollars. So in the impact investing sense, it's a concept of additionality. Like we think that there is scope to have impact in private investments, i.e., for outcomes in the real world that wouldn't happen without our dollars supporting those activities. So a couple of examples here. Community Finance I've talked about. Lodestone is a private large-scale solar developer. Woolaid makes plasters that are not made out of plastic. Mint Innovation, a company I met with last week, they're trying to grind and melt down chips from all sorts of e-waste and sell gold and other precious metals that sit on the back of those chips. So that's quite a cool technology. A little bit more on our investment process, and just keeping an eye on time here. So we start with a broad universe of global companies. Typically don't do a lot in small caps. We kind of trim that down with different quant filtering and optimization tools around carbon, ESG metrics, then fundamental attributes like risk, which we sort of proxy with balance sheet and debt service metrics, momentum, earnings per share and price, valuation, a range of metrics we use there, including a short form DCF. Then once we have that, we kind of get down to a core portfolio, which we supplement with a kind of discretionary portfolio, and the discretionary portfolio is where we sometimes implement more of those positive themes. So those are companies that might not tick all of the boxes in terms of those quant metrics that are mentioned in the middle there, but which we think, fundamentally, as well as for the positive attributes we see in respect of our themes and our ethical approaches, companies that we will invest in. A little bit on philosophy here, and this is a little bit higher level. We try and invest a little bit for the world we want, rather than necessarily for the world we're in right now. So that, it incorporates things like a focus more on renewables, and we do exclude, fossil fuel companies entirely. We use a range of, risk monitoring tools to assess the quantitative risk attributes of our portfolios, and try and invest, where our conviction lies at the stock level, both in terms of the financial side of that duality, but also the ethical and collective well-being side of our duality proposition. There's lots of different ways to cut some of the themes in our portfolio. Like if you think of digitalization, for example, our portfolio's around 32% in global equities and tech, and a large degree of that you can think about as digitalization. But this is a little bit more of a narrower kind of conception of some of our positive impacts, and you can see the types of allocations that we have to some of these companies. A little bit dated, some of this information now, but in general, these are much, much larger allocations than a sort of broad market index to these areas. So that is all on the presentation. I'll try and cut back to chat and see if we had anyone come through with suggestions as to what the most important thing was. And I don't see anyone jumping into the chat room there. That's all good. The most important thing for us is, firstly, well, it is our clients, but a part of that is actually the ancestors of our clients. So we talk about one of our values as being good ancestors. So that means, trying to invest to create the world we want, and thinking about the ancestors of our current clients too. So that's all from me. And I forgot to say a quick, thanks and congrats to David and Rachel for what I thought was a very good presentation. And I think they're doing a great job with ESG integration. Rachel and I have worked on a number of industry initiatives around responsible investment together, and I think that's one of the cool things about the responsible investment community in New Zealand is a lot of different firms do, try and work together and partner and support each other as we try and, make some sort of, positive change around the industry over time.
Agreed.
So,
Well, sure, got there. We'll come back for Q&A in a little bit. Is that showing up okay? Cool. Yeah, obviously, thanks for both presentations. We kind of had a little bit of everything, which was quite good in terms of exclusionary processes and ESG integration through to thematic and impact. So you can sort of see how it kind of fits under a lot of those slices that we're talking about before. I thought we could just briefly mention having a look at some of the market data, and then that could lead us into the Q&A. So this was just sort of from some recent Morningstar data that came out earlier this year. And just in terms of what's going on in the world, it's quite interesting. So you've got quite a change in Q1 2025. So Europe had been, sustainable again, but generally adding cumulatively to sustainable market flows, and then reverse that trend in Q1 2025. It's back on track. It is adding cash to the pot again, which is interesting. You can also see at the bottom, the dark green, basically mostly negative on the axis there, US continuing to withdraw funds from the global sustainable marketplace. We've also got, hopefully, frozen. Cool. Just in terms of European, because European tends to lead the way with a lot of these things, just having a quick look, passive exposure making up the bulk of the European fund flows. This is quite interesting too, just in terms of those European fund flows. So in the second quarter of 2025, Morningstar identified about 600 funds that were renamed. 383 dropped their ESG related terms altogether. 186 replaced an ESG related term for another, and 26 added ESG related terms. So quite a lot of name changing, probably to do with over the other side of the Atlantic. And we'll have a chat about how that influences things in New Zealand. In terms of what's going on in NZ, I've made this so small so I can't see it, so I'll have a look up here. Obviously, through time, we've had a bit of a peak 2021 in terms of sustainable fund launches, sort of tapering off, market obviously maturing a little bit. And then what have we got? NZ investment flows, so Q2 2024 looking quite good. So I'll leave it up to Q&A, and the participants have a chat about how that data sits with them, both in views on global and local. Have we got any questions, Louisa, that come through the chat? Let me see if I can find that one.
My comment just quickly on the sustainable fund creation. My view would be that we've sort of seen, we've now got a saturation of sustainably minded funds anyway across, the globe. Plus also I think we're seeing sustainable thinking embedded across all funds rather than it being a separate, just these funds, so it's a broad consideration. It's all you're thinking about is non-financial risks that are material to a company.
They're almost becoming conventional.
Yes, exactly. So I would think that that's what's reflective of the in terms of the new product offerings. But yes, obviously, with dear old Mr. President in the States, there's obviously been those name changes and things like that happening. But
There's probably to some degree as well in terms of the ESG dropping off the names of funds. Some may have promised something that wasn't there. I mean, the greenwashing comment you often hear.
I think that's a huge part of the reason why most of these funds are renaming.
Yeah, exactly. And some of them will have sort of promises that they're just really not achieving. Some of them might just have a simple exclusion and that's it, which is, you know, you could argue not much of an actual tilt, especially if they're talking that. So, yeah, a lot of movement.
Do you think it's driven more like from the Article 8, Article 9 distinction, just firming that up as opposed to the US sort of people kind of pandering to that?
Yeah, I think probably that it sort of started and then people realised, oh yeah, okay, we need to sort this out for the Article 8 and Article 9 reporting. Obviously the EU are seeing some pulling back in their reporting requirements, so there probably is some more influence from the US than I would have liked, you know, because Europe, as you said, tends to sort of lead the way and do their own thing, and you know, everyone tends to follow. But you know, certainly talking to colleagues who work for MSCI, for example, MSCI has gone through and removed ESG from everything, all their titles and things like that, but they're just replacing it with something else, whether like usually sustainable. So you know, Trump seems to have sort of latched on to ESG being the bad thing, and so people are just changing the name. And of course, there will be people who are taking advantage of the fact that it's, you know, Trump is bagging it, and so they can sort of, yeah, go back to not incorporating it necessarily, but yeah, I think the trend has mostly been that it's sort of just part and parcel of a standard approach now.
Yeah, I'd be interested on David's view as well. But it does feel that within Australasia, that most companies that have gone down an ESG route, whether it's more an integrated or an ethical, it does feel like there's not been a lot of backing down and changing, which is good to see.
Yeah, I was going to ask how that, you know, from the New Zealand perspective, how does that look? So you've got, do we change because everyone else is changing, or could we be considered, you know, I guess like Europe obviously just doing their own thing? Do you think Australasia's doing its own thing, or are we going to get battered by the storm?
I think to a degree we are doing our own thing, especially more around the sort of ESG integration is very much the norm now across a lot of funds, and I think most are doing a good service to that. Maybe from an ethical front, David, do you have a view in terms of what you're seeing in Australasia about people sticking with what they've gone to?
Yeah, I think I'd agree with most of the comments there thus far. I think, yeah, in the ethical piece of the market, which again, you know, terminology across all of these subsegments, as David referred to, can differ in different parts of the world, and the way that different people use or understand those. But yeah, you know, in terms of how we think about ethical investing, there's, you know, not a lot of change. I can't think of anything we've sort of dialed back in our policy. There are one or two examples, or a small handful in Europe of responsible investment approaches that have sort of dialed back some of their thinking around defense companies. But at the same time, you know, some of the ethical investors up there are excluding certain US technology companies, given their ties to activity in the Middle East and Israel and Gaza. So, yeah, I think at the ethical end, most institutions, you know, if they're sort of thinking about that as a core part of what they're trying to achieve, then it's, you know, they're pretty reluctant to sort of dial back significantly you know, the way they're implementing their process. I guess for very big managers that have a lot of different products, and there are many European managers in this category, you know, that can be a bit different because they sort of position different products in different ways over time. And there has been a bit of a rollback of so-called Article 9 funds, which in Europe are effectively the most sustainable, and that reflects many factors, which is probably a bit outside the scope of today's discussion. But yeah, Rachel and David touched on that before.
I think maybe one area I've noticed it at the edges at least is it's more around the corporates themselves in terms of what they present. Whether, you know, some of them used to lead with ESG slides or used to be right at the front of the pack. Now it's sort of drifted back a little bit. It's not gone, and I'd say most Australasian you know, listed companies are still there, but the ones that are a bit more international, you can probably note a little bit of a de-emphasis. It might sit in the appendix rather than be front, but it is more subtle, and not all corporates are doing that depending on where they sit, but we have noticed a little bit of that.
Has anyone got any views on the, I guess, the regulatory landscape? Because just within New Zealand and the focus, and sort of how they're thinking about maybe even discussing with the FMA about how to approach things. particularly around the greenwashing angle or any developments from ASIC, that sort of stuff?
Oh, look, I'd say like, yeah, for greenwashing has been a focus for ASIC for the last few years, and certainly the FMA have been indicating that that's, you know, a focus for them as well, and I don't see that changing. You know, that's, yeah, we you know, have good discussions with the regulator quite frequently. That, yeah, we're, you know, I guess, yeah, part of this industry collaboration is also talking to regulators and talking with other fund managers and things, because we need the settings that we're working within to also be helping us, you know, move towards a more sustainable situation. So, yeah, so, you know, potentially there'll be funding issues for someone like the FMA from government changes that might mean they can't go as deep into greenwashing as they might want to, but certainly it will still continue to be a focus of theirs from what I understand. Yeah.
And a common theme that's more from boards and I guess time soaked up, things like the CRD reporting, which was a sort of step forward in climate reporting, was seen to be quite an amount of resource required and a cost for a lot of people. So I know that the government and other areas are looking at sort of ways to maybe do it more efficiently, or do we sort of pool resources across industries or sectors in terms of reporting and who's required to. So, you know, so there are some sort of small changes in those areas too, but it's in the right direction, but it's just making sure it's not too costly and timely.
Yeah, looks like we just got a question that came through. Seems that we've answered a bit of it already, just in terms of the evolution of in the industry in the space over the next 3 years, basically around regulation, which I think we just talked to, which was good. Also reporting disclosures, which I think you also just mentioned, and then customer views and preferences. So I guess, yeah, any direction of travel, I guess, that you see within the sort of product space, that things that might be coming to market, or without revealing too many secrets, but just to sort of trends within the market.
Oh, look, I mean, I think, you know, ideally my role would not exist in 10 years time, and there's no need for a head of responsible investment, because responsible investment is just the stock standard thing that everyone does. So certainly, you know, things always wax and wane. I think as much as this, you know, the government in New Zealand has been similar in terms of pulling back certain things, I don't see them, you know, completely axing everything. Even the climate reporting is a good example. They've, you know, they're not completely getting rid of it. They are just sort of tampering it back a little bit, but I think that's reasonable for, because it has been a, you know, a very, yeah, highly resource intensive process, but that's not to say that they'll get rid of it completely. Yeah, so yes, exactly. Yeah, and so very much, and there's also sort of intricacies within the regulation itself, like what it's trying to achieve and how the standards are written don't actually line up very well. So what is being produced and what they're trying to achieve with it is not matching up. And we're talking to the XRB about that as well. So yeah, so I think there will always be, and David's examples, for example, around defence companies, there will always be sort of global events or changes in government that will mean there's, you know, a little bit of movement back and forth, but I think generally the trend will continue. I guess in this, I view it as the positive direction of generally continuing to go down this path. Yeah.
If we can just chip in, because the question was on client end demand. So for Mint, we largely focus on an institutional end client base, and certainly when they're reviewing our investment process, the ESG component of that review is still equally as intensive as it used to be. So certainly from a domestic institutional perspective, there's no pullback in terms of focus on ESG.
Any parting comments, David, on that one as well?
No, nothing. Yeah, nothing in particular to add. I mean, I would maybe briefly point out that the FMA has also highlighted private assets as something they're focusing on in the year ahead, so that, you know, for some managers such as us, that kind of overlaps with the parts of the ethical process. But yeah, they've also talked about ethical disclosures as part of that. But yeah, on the product side, yeah, great to see more clients and to hear that more institutional clients are interested. I think in particular in kind of charitable investment sectors, you know, that, you know, we're seeing an increased need really for institutional managers to be able to show that that they have sort of best in practice process around ESG integration, and for some of those investors want more than ESG integration and think about concepts like impact as well.
Yeah, you can see that if it's going to be private market focused, they're obviously going to look at the impact investing quite a lot.
Mm-hmm.
Also some of the thematic funds. Cool, I think that's probably a good place to wrap up. I want to thank everyone today, particularly Mint and Pathfinder and all our viewers. I think that's all our questions answered as well. So I think we'll call it a day there, and thank you everybody. Have a good afternoon.
Thanks all.
Cool.
Thank you.
Thanks, guys. Yeah, on time as well.
That's great. It's like,
Yeah.